Hello viewers, welcome to my channel. I'm Hasham. So now I'm starting the next problem, that is 22nd problem on ratio analysis. Till the last video 21 problems I have completed. Now from here onwards every problem will be a different problem. So if you are more interested in learning, in getting a complete command on this ratio analysis, watch the video till the end. Don't skip in between. So I expect that you have an urge to learn this topic. This topic is very important for graduation, post-graduation and professional studies. Because this is the most widely used technique for analyzing the financial statements. So most of the organizations will use this technique in order to take the decisions regarding liquidity, profitability, structure, activity, all these things. A lot of information will be generated by using this ratio analysis. So before joining now, I expect my viewers that you have watched all the earlier videos. If you join right now, you may not be able to understand. So my suggestion, go to the playlist of my channel, select the subject financial statement analysis, select the topic ratio analysis, watch the beginning videos. I've explained in detail regarding the meaning of the term ratios, advantages, limitations, classification and formulas. All these things I've explained. So without watching those videos, you cannot be able to understand. So all the problems are based on the formula. Be perfect on the formula. Then after watching these videos, you will be in a position to give the interpretation also. Now I'm going to start the next problem number 22nd. So before starting the problem, I expect my viewers to have a hard copy printout of these problems, which I have given in the link under my description. So take a printout and keep it ready. Now I am reading out 22nd problem. Considering only the following data, would you as a banker extend short-term credit to the concern? No calculations, nothing, only interpretation is required. You as a banker, will you extend the loan to this concern or not? So banker will ask the concern, business concern, to provide the information. The business concern has provided the information, calculated ratios, current ratio 1979, 80, 81, 82. 4 years ratios are given. So what are the ratios? Current ratio is given 2, 2.2, 2.5. I have represented on the board also here. You can see 1979, 80, 81, 82. The ratios are current ratio 2, 2.2, 2.5, 3. So if you closely watch the current ratio is increasing from 79 to 80, 80 to 81, 81 to 82, continuously increasing. It's a better sign. Because when current ratio increases, it means the liquidity position of the business is good. The business will be in a position to repay. Liquidity means ability of the business to pay the current obligations on time. So current ratio is showing an increasing trend. That means liquidity position good. But not only current ratio, we have to consider. See here, we should consider a number of ratios. We should not depend only on one ratio. The decision will be taken collectively by considering all the ratios, not by a single ratio. Now we consider the next ratio, acid test ratio. This is the quick ratio, liquid ratio. This is the more liquid ratio. So if you compare the acid test ratio 1, 0.9, 0.85, 0.17. What do you observe? The acid test ratio is declining. So there is a controversy here. Contrary. That means current ratio is increasing, whereas acid test ratio is declining and very severely declined. That means the difference between this current ratio and acid test ratio is on account of stock. The stock is accumulating. That means the business is purchasing the stock is accumulating, increasing. The business is unable to convert the stock into sales. It is evident from these two ratios. That current ratio is increasing, but acid test ratio, quick ratio is declining because the company is unable to sell the goods. The stock is accumulating. That's why the quick ratio is declining. Now it is evident from this inventory turnover. Next ratio is given inventory turnover. What do you mean by inventory turnover? How many times a business is converting the stock into sales? Stock into sales. That means if the inventory turnover ratio is more, that means the company is fast in converting the stock into sales. Immediately it is converting, very fast rate. It is converting the stock into sales. But here you see inventory turnover ratio. In 1979 it is 8, come down to 7, come down to 6, come down to 5. That means inventory turnover ratio is declining. The company cannot be able to convert the stock into sales. Difficulty in selling the goods. Difficulty in selling the goods. That's why inventory turnover ratio is coming down. Lastly, debtors turnover ratio. Debtors turnover ratio shows how many times the business is converting the debtors into cash. Debtors are created when we sell the goods, and debtors will pay the cash. A high debtors turnover ratio indicates that debtors are paying fast. Debtors are paying fast. But here the debtors turnover ratio 7 times, 6 times, 5 times, 4 times. That means debtors turnover ratio is less. Very rarely we are getting the money from debtors. That means we are shortening the credit period. Our credit period is low. When the credit period is low, our sales are less. The stock is accumulating. Stock turnover ratio shows stock is accumulating. Quick ratio shows that our quick ratio is declining. So from this information, we can conclude that the short-term liquidity position of the business is not good. From these ratios, the banker will not give the loan to this concern. It is not desirable to give the loan to this concern because in this concern the liquidity position is not good. The stock is accumulating, the business is unable to convert the stock into sales. That's why the asset test ratio is declining. So ultimately, although current ratio is increasing, the liquid ratio is falling and it is very low. You can say as asset test ratio is the liquid ratio. Asset test ratio is the liquid ratio. It is declining and it is very low. And the reason for this is increase in stock which is getting accumulated. The stock is increasing, that's why current ratio is more, but asset test ratio is less. When we remove the stock, the quick ratio, the asset test ratio is declining. And this can be deduced from fall in stock turnover ratio. We can conclude that stock is accumulating because it is evident from this inventory turnover ratio. Inventory turnover ratio is declining. Next, perhaps a stricter credit policy as indicated by fall in debtors turnover ratio has led to a fall in sales. That means the company might have decreased the credit period. That's why sales are declining. Debtors turnover ratio is decreasing. That means company is giving lower credit period. Due to lower credit period given to customers, the sales are declining. So, led to a fall in sales. In such a situation, it is not advisable to extend credit to the concern. According to this ratio, it is evident that if we give the loan, if we are having a banker, we are the banker. If we give a loan to this concern having this performance, it will be difficult to recover the amount of loan and interest from the concern because this is the situation. That's all. So in this problem, we have not calculated anything. We have deduced the information from the given ratios. From the given ratios, we have come to the conclusion that it is not advisable to the banker to extend the loan to this concern. That's it. So this is the end of problem number 22. Now I am coming to problem number 23. The following information relate to Rajasthan Manufacturing Company Limited, the balance sheet as at 31st December 1973-1974. The 2 years data is given 1973 and 1974. What are the information given? Cash at bank, bills receivable, stock in trade, expenses, prepaid expense. So cash at bank, bills receivable, stock, prepaid expense, these 4 are current assets. Then fixtures, furniture and fixtures, building, land. These 3 are fixed assets. Then Current liabilities are given for both the years. Then shares, equity shares of rupees 100 each. Then general reserve. These two are shareholders fund. So we are given current assets, we are given fixed assets, we are given current liability, and also we are given shareholders fund. Now profit and loss items for the period are net sales. Net sales are given for both the years 1973, 1974. Cost of goods sold. So sales minus cost of goods sold will get the gross profit. Then we are given general administrative expenses, indirect expenses. So from gross profit, if we deduct this administration expense, we'll get profit before tax. We'll deduct income tax, we'll get profit after tax or net income. This is the information given. From the above information, compute the following ratios. The 4 ratios it is asking you: current ratio, inventory turnover ratio, net sales to receivables ratio, net income per share. These 4 ratios it is asking you to calculate for both the years 1973, 1974, and briefly analyze and interpret the above. After calculating the 4 ratios, you have to analyze and interpret, give the interpretation about these 4 ratios, indicating favorable and unfavorable operating conditions. Indicating the favorable and unfavorable operating conditions. That's it. So first of all, we'll classify the data. The information given in the problem is current assets. Calculation of ratios. Current assets are cash at bank, bills receivable, stock in trade, expenses, prepaid. These 4 are current assets. I have taken the total of current assets 166, 173. This is rupees in thousands. Rupees in thousands means it is 1,66,000. This is 1,73,000. I have removed 3 zeros. I have taken 166, 173. Current liabilities are 6957. Actually 69,000, 57,000. 3 zeros are ignored. So 6957. Then fixed assets are given: furniture and fixtures, building, land. The total of the fixed assets are 125, 150. Shareholders fund consists of share capital and general reserve. Then net sales are given for both the years. From net sales, we have deducted cost of goods sold. What we get is gross profit. From gross profit, I have deducted administrative expenses. We'll get profit before tax. Deduct income tax, we'll get net profit. So from the given information, I have taken all the items. I have analyzed and got all the values. Now I am going to calculate the specific ratios. 4 ratios it is asking you. So 1973, 1974, first I am calculating current ratio. Current assets by current liabilities. So I am having current assets here 166, current liability 69. 166 by 69, 2.41 is to 1. Then 1974, 173 by 57, 3.04 is to 1. So I have calculated the current ratio for 1973, 1974. Second ratio it is asking you to calculate inventory turnover ratio. The formula is COGS, cost of goods sold, divided by average stock. Average stock means opening stock plus closing stock divided by 2. Now see, average COGS divided by average stock. Average stock is opening stock plus closing stock divided by 2. Now 1973. For 1973, we cannot calculate average stock because opening stock of 1973 is not there. 1972 closing stock will become 1973 opening stock. But 1972 data is not given. So we cannot calculate average stock for 1973. So alternatively, I can take the closing stock. What is the closing stock of 1973? Stock in trade 89. So I am taking here 1973 closing stock 89. But 1974 I can calculate average stock. Because for 1974 I am having opening stock as well as closing stock. 1973 closing stock will become 1974 opening stock. So I will take 89 plus 80 divided by 2. 84.5 is the average stock. Now we substitute. What is the COGS value, cost of goods sold? 230 and 232. So 230 divided by 89 and 232 divided by 84.5. So we got inventory turnover ratio 2.58 times. 2.75 times. That's it. So two ratios I have completed, current ratio and inventory turnover ratio. Next ratio is net sales to receivables ratio. Net sales to receivables ratio. So the formula is net sales by receivables. Net sales by receivables. We have net sales 320 and 329. So I have taken 320, 329 net sales. Divided by receivables. Receivables we have bills receivable 61 and 69. So 61, 69. Divide 320 by 61, 5.25. And here 329 by 69, 4.77. That's it. Three ratios we have completed. The last ratio is net income per share. Net profit, income means profit, net profit per share. The formula is net profit divided by number of shares. How many shares are there? So it is given the share capital. The share capital is 1,90,000. 190, 3 zeros are omitted. That means the equity share capital is 1,90,000 rupees. What is the face value per share? 100 rupees given in the problem. The face value per share is 100 and the total share capital is 1,90,000. So how many shares are there? 1,90,000 divided by 100. Number of shares are 1,90,000 divided by 100. 1900 shares are there. 1900 shares of rupees 100 each. So if you multiply 1900 into 100, you will get 1,90,000. The number of shares are not given in the problem. We have calculated. The 1900 shares are there. So what is the net profit? 56,000. 56,000 rupees is the net profit. So I'll divide 56,000 divided by 1900 shares. Rupees 29.47. So 29.47 is the net earning, net income per share. Net profit per share is 29.47 rupees. Whereas for 1973, 60,000 is the net profit. So 60,000 rupees divided by 1900 shares. So per share net income is 31.58 rupees. That's it. So all the four ratios we have calculated. Now it is asking you to give the interpretation. I am not writing the interpretation here, I am explaining. So you must have a notebook and copy down whatever I am telling. Right? So analyze. After making this analysis, we have to give the interpretation. First interpretation, the current ratio have increased from 2.41 to 3.04. So current ratio increased. That means the liquidity position have increased from 1973 to 1974. But the standard current ratio is 2:1. If the ratio is more than 3, it means it's not ideal. That means some funds are idle. Idle funds will not generate any income. We suggest the company to utilize the funds more properly. That means keeping a high current ratio of more than 3 is not desirable, not suggestible, not advisable. It is not advisable to keep the current ratio more than 3. Up to 3 it's okay. So we can say the current ratio is good. Next one, inventory turnover ratio. How many times we can be able to convert the stock into sales? It is 2.58 times. There it is 2.75 times. So inventory turnover ratio is low. 2.58 and 2.75 is low. Normally 8 times. We must have the inventory turnover ratio 8 times in a year. Normally standard ratio. Less than 8 means the turnover is very slow. The business cannot be able to convert the stock into sales in a fast rate. So we advise the company to increase the inventory turnover ratio. Next one is net sales to receivables ratio. That means sales are 5.25 times of the receivables, and there it is 4.77 times. The sales to receivables are showing a lower value. The company must increase this ratio. Lastly, net income per share. The net income per share in 1973 was 29 rupees 47 paise. It has increased to 31.58. So it's a good trend. It's a good trend. the net income per share has increased in the year 1974. So from this analysis we can say the liquidity position is good, the income position is also good. The only thing, the company must focus on inventory turnover and receivables, sales to receivables ratio. So these turnover ratios, the company must increase it. That's it. This is the analysis and interpretation of this. So this is the end of problem number 23. So totally 23 problems I have completed.